Welcome back to Dion Talk. A very quick video on stocks versus real estate. I'm going to try to make this short enough to where you can share it with your friends when they ask you, how do stocks compare to real estate? I made a longer video recently on why I chose one and not the other, and I will pin a link to that video in the comments below. For this comparison, we are going to say that you have $100,000 to invest. So you put $100,000 into stocks or $100,000 into real estate. How do they compare? So when it comes to stocks, we're going to go with the historical average, which is where the 4% rule comes from, of earning 10% a year. Now, some years you're going to make more, and some years it's going to do vertical pong, but you, on average, over a long enough historical duration, you're going to make about 10%. So in a year of investing $100,000 into a diversified stock portfolio, an index fund, an ETF. I'm not saying go out and pick stocks because 90% of the people who do that lose money. But you just invest this in a diversified index portfolio, and you're going to get an average return of 10%. So that would be $10,000. In 1 year, that goes up $10,000. With real estate, I own rentals, and I have never purchased one that has gotten less than a 10% return. But in fairness to stocks, I'm going to cut that minimum return I have never even got in half and say we only get a 5% return. So if I invest $100,000 into real estate, and I'm going to get what in real estate we call a cash-on-cash return on investment, I'm going to make $5,000. Now, because of depreciation and write-offs, I'm not going to pay any taxes on that. So I'm going to make $5,000. So if you want to take this clip out and send it to your friends, it looks like stocks is better than real estate because a 10% return sounds better than a 5% return. But this $10,000 is in stocks. If you want to take the $10,000 out, you have to sell some of the stocks, which would incur if it's been more than a year, a capital gain. So it's going to be taxed, which is why they use the 4% rule, right? You have to have some money in there for the taxes as you take it out, and some money in there for normal inflation. And yes, some years are more, some years are less. The cool thing with stocks is if you leave it in there, meaning you didn't take any money out, next year you're going to get a 10% return on $110,000, which would be an $11,000 return. So here's the 10,000 here, here's the 5,000 here. Now the difference is, with stocks you invest $100,000. With real estate, I invest $100,000 to acquire, with 30-year fixed rate debt, a $400,000 asset. This $5,000 is cash flow. This is not a gain in asset value. This is the money that came into my pocket. The actual gain in real estate, again, yes, for the last few years, we have seen 24%, 19%, massive increases in stocks, massive increases in real estate. And I'm using the 10% average for stocks, so I'm going to use the 5% average for real estate. While I get a 5% increase in value of my real estate, that doesn't mean I'm going to gain 5% of $100,000. That 5% comes to me in cash flow. 5% of $400,000 is $20K. Inside the asset, like the $10,000 is inside the stocks, I'm gaining $20,000. So my increase in 1 year with stocks is $10,000. My increase in 1 year with real estate is $5,000 in cash flow that I can blow. I can spend on anything I want. I get $20,000 in increase. Now, to tap the $20,000, I would need to sell the asset out or put some more debt on it. To get the $10,000, you would need to sell some of the asset. This isn't all of it for real estate either, because with a 30-year fixed rate debt, every month in a rental, a tenant is paying off in the first year somewhere around 1% in that first year of the property value. Now, because of loan amortization, that principal pay down becomes more and more and more over time, to where eventually this is even a bigger number. But 4% of $400,000 would be another $4K. So in 1 year, I'm gaining $5,000 in cash flow, $4,000 in principal pay down, $20,000 in appreciation because it's levered appreciation, and because of levered depreciation, I get to depreciate the buildings based on the $400,000 price, not the $100,000 price, I had a gain of 29% in 1 year versus 10% in 1 year with no cash in your pocket here. I'm not making this to say stocks is better than real estate or real estate's better than stocks. You need to invest in something that excites you, because you are going to get kicked in your teeth when you invest. There is risk. There will be stock market fluctuation. There will be real estate tenants, toilets, and termites, problems to deal with, interest rates changing, everything that's going to make it challenging to keep your money invested. This is why so many people don't invest. You are more likely to stick to a plan you are emotionally invested in. So I'm not saying invest based on emotion, but if stocks excite you, don't invest in real estate. If real estate excites you, don't invest in stocks. Don't invest in both. You don't diversify to become wealthy. You become wealthy by focusing on one asset class and mastering it. And then once you become wealthy, you diversify to protect your wealth. I made this video for those people who have asked, please make a video comparing stocks to real estate, the math. This is a kindergarten simple version of this, and some people will say, well, I can invest in dividend stocks. Yes, you can. And while there are some that pay 7 or 8 or maybe even 9% on a dividend, most dividend stocks pay less than 3%. So dividend stocks to me are not the solution. You can pick by looking in the last couple of years, based on these certain stocks, I would have a huge return. You can also do that with meme coins. Go back 4 weeks, buy some peanut coins. Go back 2 weeks and buy the Hawk Tuah coin. But when do you get out? There's so much risk involved in that volatility that I'm not saying crypto is not a good thing to invest in either, but a diversified stock portfolio can get you consistent returns over a long enough period of time to where you can retire on stocks. Like my friend, I call him a friend because I watch him all the time, but Joe Kuhn invested in stocks over 37 years and put his money to work and retired at the age of 54. It's absolutely possible. I didn't start until I was 40. I started with real estate. I don't think I ever made more than $60,000 until the last couple of years of working. And I only had 10 years to reach financial freedom. So if you watch the longer video, you'll see why I chose real estate. And it wasn't the math, it was other factors. I generally don't make stocks versus real estate videos because of all the hate that it brings out in the comments below. But so many people have asked for this specific example. I'm going to get out of the way so you can take a screenshot. $10,000 in 1 year, yes, with compound interest. Next year, you'd be gaining $11,000 because the amount is 110. Only $5,000 in cash flow. Again, cutting in half any return that I've ever got. Equals a 29% increase in 1 year. The next year, the cash flow might be the same. Your expenses can go up and rents can go up, but the appreciation of 5% would now be on $420,000. So we're compounding the interest, like in stocks, we're compounding the sources of increased value in real estate. I was going to wrap this video up with, I completely forgot what I was going to wrap it up with. This was a nice short video that you can share with somebody if they want to see stocks compared to real estate. If you want your questions answered during a live, every Tuesday, 4 p.m. Pacific, I do a live stream that basically lasts as long as the questions do. Have a weekend, because some people still have those, full of